Welcome to the Deep Dive, your essential shortcut to, well, really being well informed. Today, we're taking a deep plunge into the latest financial story unfolding at Eco Recycling Ltd. We're specifically dissecting their Q1 FY26 financial results, which just dropped very recently, Monday, July 28, 2025.
Right. And our mission for you on this deep dive is, to cut through all the corporate filings and the financial jargon. We're leveraging specific insights directly from the company's official board of directors meeting outcomes and their unaudited financial statements. We've also got a set of targeted questions ready, designed to get right to the heart of what you need to know about this quarter's performance.
That's exactly right. This isn't just about, reading numbers off a page. It's about understanding the compelling story behind them, what hidden factors truly influence performance, and crucially, what it might mean for eco-recycling's future, especially in the rapidly evolving e-waste management sector. And as we dive into these reports, you'll hear us use LACS, L-A-C-S, as a unit. That's 100,000, pretty common in Indian financial reporting. We'll also talk about standalone results, that's eco-recycling's core business, and consolidated results, which kind of give us the full group picture, subsidiaries included. Okay, so to really understand these financials, we probably need to start with the big decisions, the ones made at the recent board of directors meeting on July 28th. What were the standout takeaways from the boardroom there?
Well, there were two main things, really. First, the board formally approved the unaudited financial results, both standalone and consolidated, for the quarter ending June 30, 2025. That's the data we're digging into. Second, and this is pretty significant for the company's long-term path, they approved a major leadership reappointment.
Ah, okay. And this next detail sounds crucial for their future direction. The reappointment of Mr. Brikishore Soni as the managing director. What are the key implications? What does this decision signal?
Right. So Mr. Soni, he's been reappointed for a pretty substantial period, 5 years. That runs from September 1st, 2025, right through to August 31st, 2030. Now, this is pending shareholder approval at their upcoming 31st annual general meeting, but it's a strong board recommendation. Bit about him. He's a qualified cost accountant, currently the chairman and managing director, and he's often described, as the real driving force behind the company's success. And you can see why. Under his leadership, Eco Recycling has really emerged as India's leading e-waste management company, with a dominant nationwide presence.
Okay, so established leader, proven track record. What about his vision going forward?
Well, his vision includes steering strategic growth, naturally, but also exploring some interesting new horizons, like this franchise-led retail model concept. The idea seems to be to share e-waste management opportunities more broadly, and he's apparently very dedicated to positioning India as a global hub for e-waste management. It's also worth noting it's something of a family-driven enterprise. He is the husband of Mrs. Aruna Soni, who's a whole-time director, and the father of Mr. Shojang Soni, who serves as both a whole-time director and the company's CFO.
Interesting dynamic there.
Yeah, and so these long-term reappointment, it isn't just about stability, though that's part of it. It feels like a firm commitment to this potentially disruptive, decentralized growth strategy, through franchisees. It really signals a future where eco-recycling is aiming for widespread market penetration, possibly at the cost of some short-term centralized control, maybe. They seem to be betting on future scale to dominate the e-waste sector. It also reinforces the company's dedication to a pretty bold, expansive vision for India's role in global e-waste management.
Understood. So a clear signal of continuity and ambition at the top. With that long-term strategic view set, let's turn our attention back to the immediate financial performance. The quarter ended June 30, 2025. What was the overall picture? How did they actually do this past quarter?
Okay, let's break down the core numbers, focusing on the trends. Revenue from operations, both standalone and consolidated, came in at 924 lakhs for Q1 FY26. Now, this is a noticeable dip from the same quarter last year, Q1 FY25, which was quite a bit higher at 11,140 lakhs. It was also a slight decrease from the quarter just before this one, Q4 FY25, which was 977 lakhs. So, yeah, suggesting maybe a general slowing trend in top-line growth. And it's interesting, as you mentioned, the standalone and consolidated revenues were identical. That tells us there wasn't any significant operational revenue coming in from their subsidiaries this quarter.
Okay, revenue down year on year and slightly down quarter on quarter. What about the bottom line, the profit?
Right, now that's where the picture gets quite different, a bit more complex. Standalone net profit was 671 lakhs in Q1 FY26. That's actually a significant jump from the 311 lakhs in Q4 FY25, the previous quarter. However, it was still a decrease compared to the 741 lakhs they posted in Q1 of the previous year. So better than last quarter, worse than last year. Then on a consolidated basis, the net profit was 809 lakhs in Q1 FY26. Again, a strong improvement from the 220 lakhs in Q4 FY25. But again, just slightly down from the 815 lakhs they had in Q1 FY25.
Okay. And the earnings per share, does that follow the same pattern?
Pretty much, yeah. Standalone EPS was 3 rupees 48 paise in Q1 FY26. That's more than double the 1 rupee 60 paise from Q1 FY25. But again, down from 3 rupees 84 paise in Q1 FY25. Consolidated EPS followed suit, 4 rupees 19 paise in Q1 FY26, way up from 1 rupee 19 paise in Q4 FY25, but still slightly below the 4 rupees 23 paise from Q1 FY25.
So that's quite a puzzle, isn't it? Revenue dipped year over year pretty clearly, but net profit saw this, well, pretty strong rebound quarter over quarter. As an analyst, what's the very first thing you'd look at to unravel that apparent contradiction?
That's a great question because, yeah, immediately raises a flag. What drove these figures, especially that surprising jump in net profit despite lower revenue? Let's look at the cost side first. Materials consumed, this is interesting, saw a significant increase, jumped to 861 lakhs in Q1 FY26, compared to just 166 lakhs in Q1 FY25. A big jump. But offsetting that somewhat, there was a large negative figure for change in inventory. It was minus 651 lakhs in Q1 FY26. This effectively reduced the total expenses reported. It suggests a major reduction in the company's stock, almost like they were clearing out old inventory maybe, that can temporarily make costs look better.
Right, selling off existing stock rather than just producing new stuff from new materials.
Exactly. Then, employee benefits showed a slight decrease, down from 94 lakhs in Q1 FY25 to about 78 lakhs standalone and 81 lakhs consolidated in Q1 FY26. Not a huge move, but down. And crucially, finance cost. It remained low and consistent at just 15 lakhs. And the financial statements, they explicitly state that this finance cost relates only to lease liability. They add, and I quote, "The company does not have any financial borrowing." That's a really strong indicator of financial health, efficient capital management. They aren't carrying significant debt.
Okay, that's a fascinating look at the cost side. The inventory change seems key there. But if costs weren't the sole driver of that profit boost, where else could it be coming from? I'm looking at the other income line here, and wow, it seems to have seen a dramatic increase, especially when you look at the consolidated results.
You've absolutely hit on the critical point there, yeah. Standalone other income was 296 lakhs in Q1 FY26. That's up quite a bit from 113 lakhs in Q1 FY25. But the consolidated other income, that truly soared. It hit 438 lakhs in Q1 FY26. That's a huge jump from 204 lakhs in Q1 FY25. And this is where we need to turn to the emphasis of matters section in their limited review reports. Now, this section, it's basically a heads up from the auditors, right? They're drawing attention to something really important in the financials, even if it's not technically a misstatement. And in this case, the primary driver, the big reason for the significant other income, is a large insurance claim.
An insurance claim. Okay, tell me more.
Right. So Eco Recycling Ltd had filed an insurance claim for 4 crores, 24 lakhs, 95,056 rupees. Let's call it approximately 425 lakhs. This was to cover loss of inventory and also the restoration of electrical and electronic fittings, presumably after some kind of incident, maybe a fire or something similar, though the report doesn't specify the exact cause. Now, they've already received 2 interim payments on this claim. First was 33.75 lakhs, and the second was much larger, 225 lakhs. So that totals about 259 lakhs received to date. They recognize this income in the quarter. The remaining balance, which is around 166 lakhs, is expected to be claimed once the restoration of the fixed assets is complete. And the report says that restoration work is currently in progress.
Wow. Okay, so while the bottom line, the net profit, looks strong on the surface, it seems heavily influenced by this significant and presumably one-time event, this insurance money. So this payout fundamentally boosted the company's total income and, as a result, its net profit for the quarter. It offers that crucial explanation for the positive profitability we saw, even though the core operational revenue dipped slightly.
Precisely. This quarter really exemplifies a crucial lesson in financial analysis, doesn't it? It shows how these extraordinary one-time income events can dramatically inflate the bottom line numbers. It makes it absolutely imperative for analysts, investors, anyone looking at this, to strip out such items, to really assess the true health and profitability of the company's core recurring operations. You need to see what's really going on underneath.
That's a powerful insight, absolutely critical context. So, with this one-time boost kind of mentally set aside for a moment, how does the company's core operational structure, its focus on that single business segment, how does that contribute to, or maybe even limit, its ability to generate sustainable profits going forward?
That's a great question because what's fascinating here is understanding that operational landscape itself. As you said, the company operates in just one business segment, e-waste management. That's it. So all their core activities, revenues, costs, everything, it's intricately tied to this specific area. Now, that simplifies the focus, which can be good, but it also means their fortunes are entirely linked to this one sector's performance and dynamics. Now, for the consolidated results, we also need to briefly mention those two subsidiaries, Ecorico Enviro Education, PVT Ltd, and Ecorico Park, PDT Ltd.
Right, the ones that didn't contribute operational revenue this quarter, what's their status?
Well, as of June 30, 2025, their total assets were 68.1 lakhs and 878.81 lakhs, respectively. So Ecorico Park holds more significant assets. But, and this is crucial for understanding their current contribution, their revenue from operations for Q1 FY26 was NIL, 0, for both of them. They did contribute a tiny bit to the net profit loss after tax line, about 1.07 lakhs profit from the education one, and actually a loss of 137.19 lakhs from the park one. So one small profit, one larger loss on paper this quarter. So yeah, while they hold assets, particularly Ecorico Park, they're not currently generating operational revenue. They just have a small, slightly negative overall impact on the consolidated bottom line right now.
Okay. So single operational focus, subsidiaries not yet contributing revenue. And as we look forward then, we have that confirmed continuity of leadership. Mr. Brickshaw Sony's reappointment signals a steady hand at the helm for the next 5 years.
Exactly. And this ties directly back to his stated strategic goals that we talked about earlier, leveraging that franchise-led retail model, potentially expanding opportunities in e-waste management quite widely, and that ambition to help position India as a global hub for the sector. Plus, we also have the ongoing progress on that significant insurance claim, right? There's still a substantial balance, about 166 lakhs, still to be received. That could continue to impact reported income in future quarters as well, depending on when the restoration is finished and the final claim is settled.
Right, another potential one-off boost down the line. So pulling it all together, what does this all mean for you, the listener, trying to grasp the dynamics of Eco Recycling Ltd? We've seen a quarter where, well, a significant one-time insurance payout heavily influenced profitability. It essentially masked a slight dip in core operational revenue. We also saw stable leadership confirmed for the next 5 years with some pretty ambitious plans for the future of e-waste management.
Yeah, this deep dive really highlights how crucial it is to look beyond just the surface numbers. You absolutely need to understand the specific one-time events like this insurance claim or the underlying strategic moves, like the focus on franchisees, that truly shape a company's performance in any given period. You can't just take those top line or even bottom line figures at face value without digging deeper.
Definitely. So as you reflect on this, here's a final thought to maybe mull over. In a rapidly evolving industry like e-waste management, how much is a company's long-term strategic vision, championed by consistent leadership like Mr. Sony's, truly outweigh these short-term fluctuations? Fluctuations driven by unexpected events like, say, an insurance claim. What kind of balance sheet ultimately tells the most compelling story about a company's future potential? Is it the steady operational grind or the visionary, sometimes bumpy path forward? Something to think about.